When you truly master supply and demand, you begin trading with smart money. You will know exactly when to enter, exit, and how to maximize profits while minimizing risk. To master this concept, you must understand 5 core pillars. What supply and demand is, how to identify and draw zones where to enter and exit, trade shake quality versus low quality, zones why some zones work and some fail. Supply and demand zones are the true engine behind every major market movement. And the mistake most traders make is treating them like simple rectangles on a chart. They are not shapes. They are footprints. Footprints of where banks, hedge funds, and institutional algorithms placed large orders in the past. These zones form because price paused, accumulated, or aggressively moved away, revealing where the strongest buying or selling pressure previously existed. When price returns to these areas, it is returning to unfinished business. Think of the market as a constant cycle between balance and imbalance. Balance is the quiet phase. It is slow, sideways, unpredictable, almost designed to frustrate the impatient trader. This is where orders are collected, where liquidity builds, and where institutions prepare for the next move. You will often see small candles, wicks, hesitation, and choppiness. Nothing big is happening here on the surface, but behind the scenes, orders are stacking. Then comes imbalance. A sudden burst. A powerful move. A candle that breaks structure, clears liquidity, and leaves a trail behind it. This moment is not random. It is the result of those large institutional orders finally triggering. When you see an explosive push in one direction, you are looking directly at the evidence of institutional intention. And this is where the strength of a zone is proven. If price leaves an area with force, that zone holds high value. If the departure is weak, slow, or indecisive, the zone is unreliable, fragile, and easily broken later. Your job as a trader is simple. Learn to read the difference between balance and imbalance. Recognize where the strong moves began. Identify the origin of momentum. Because when price returns to the birthplace of that force, it often reacts with the same energy. This is how you stop guessing and start aligning yourself with the real power behind the charts. Supply and demand zones exist in 2 major forms. And once you understand the difference, you start seeing the market with absolute clarity. A supply zone forms when price rises into an area, slows down, and then drops with force. This is the classic reversal pattern. Rally base, drop. The rally tells you buyers were in control. The base shows hesitation, a moment where big players quietly place sell orders. And the drop confirms that institutional sellers finally pushed the market down. This type of supply zone marks the end of an upward move and the beginning of a new downward leg. The second type is continuation supply. This happens in a clear downtrend. Price drops, pauses for breath, forms a small base, and then continues falling. These continuation zones are powerful because they show that sellers are not finished yet. They simply paused before sending the next wave of orders. Demand zones work the exact same way, but in the opposite direction. Price drops, finds a pocket where institutions begin buying, then reverses or continues upward. Whether it's rally base, rally, or drop base rally, the principle stays the same. These zones reveal where the strongest hands are active, and following them brings you closer to precision trading, identifying and drawing supply and demand. Zones becomes incredibly simple once you understand the logic behind the 3-step method. Everything begins with momentum, because momentum is the signature of institutional activity. When you see a long, explosive candle, a candle that moves with confidence and leaves no hesitation behind, that is your first clue. It tells you that banks and institutions executed a large number of orders in that moment, creating an imbalance in the market. From there, you look one step backward. You identify the candle before the explosive move. This candle acted as the base, the hidden footprint where orders were stacked. It may look harmless or small, but it's the exact moment where the market paused before the big push. That candle becomes the core of your zone. Now you mark it. Draw a rectangle from wick to wick, covering the entire base. This rectangle is not random. It represents the exact price range where institutions place their orders. And price, sooner or later, has a habit of returning to these same zones. When price returns, you do not jump in blindly. You wait for a clean retest, a controlled touch, a moment where price respects the zone. Only then do you enter, catching the market at the same level where the giants traded. When it comes to trading supply and demand, your entry, stop loss, and take profit placement can either make you a consistently profitable trader or someone who keeps getting shaken out of perfect trades. Everything begins with patience. You never enter just because a zone exists. You enter only when price comes back to that zone, touches it, and shows respect. That retest is powerful because it confirms that institutions are still defending that area. Without a retest, you're simply guessing. With a retest, you're aligning yourself with the strongest hands in the market. Once your entry is confirmed, the next element is your stop loss. And this is where many traders overthink. A stop loss is not an emotional barrier. It is a technical one. If you are selling from a supply zone, your stop should sit just a few pips above the zone. Not too far, not too tight. Just enough to protect the trade if the market truly violates the zone. The logic is simple. If price breaks above your supply zone, the idea behind your trade is no longer valid. The same rule applies to buys. If you're buying from a demand zone, your stop loss goes just a few pips below the zone. You give the market breathing room, but you don't give it unnecessary space. Now, your take profit is where you lock in the reward, and this is where discipline separates professionals from gamblers. You always aim for the next opposite zone. If you are selling from supply, your target is the nearest demand area. If you are buying from demand, your target is the nearest supply. The market moves from zone to zone, from imbalance to imbalance, and your job is simply to catch the leg between these points. Trying to predict more than that usually leads to holding too long, watching profit evaporate, and reacting emotionally as the trade progresses. You have an optional but very effective adjustment. You can move your stop loss behind structure. If you are buying, you trail your stop below the most recent higher low. If you are selling, you shift it above the most recent lower high. This method protects profits while letting them move breathe naturally. When you follow this structure and tree on retest, stop loss outside the zone. Take profit at the next zone. You eliminate the noise, reduce emotional mistakes, and start trading like the institutions whose footprints you're following. Not every supply or demand zone carries the same weight. Some zones have the power to reverse the entire trend, while others barely hold for a single candle before collapsing. Understanding the difference between high quality and low quality zones is one of the most important skills a trader can develop because it teaches you where real institutional power lies. A high-quality zone always begins with strong, undeniable momentum. You'll see large candles, long bodies, minimal wicks, and a sense of urgency in the market. It feels like the price was pushed, not gently guided. This is the footprint of big orders being executed. When institutions step in, they don't place tiny orders. They unload massive positions that create imbalance, causing price to explode in one direction. That explosive move is what gives the zone its strength. Because if the market left quickly, it usually means a large number of orders were left unfilled. And the market loves to return to these areas to collect those leftover orders. That's why high-quality zones hold so beautifully on retests. Low-quality zones, on the other hand, are the complete opposite. They're built from weak candles, tiny movements, and slow, indecisive price action. The market moves like it's tired. There's no power, no conviction. These zones often form when only retail traders are active, or when the market is waiting for news. The imbalance is weak, and because of that, the retest rarely holds. Price chops around, disrespects the zone, or simply slices right through it. These zones may look neat on the chart, but they don't contain institutional footprints. And without institutional presence, a zone loses its meaning. The rule is simple, but powerful. The stronger the momentum, the stronger the zone. Momentum tells you who's in control. If the move is sharp and clean, institutions are active. If the move is soft and choppy, retail traders are fighting each other. When you learn to judge zones based on momentum, your trading transforms. You stop taking every random setup. You stop relying on hope. Instead, you choose only the zones that carry weight. Zones that have the strength to protect your entries and push price in your direction. That one shift alone dramatically increases your accuracy and reduces your emotional stress. High-quality zones become your map, guiding you toward the most reliable trades on the chart. Supply and demand zones don't work by magic. They work because they follow the deeper logic of market structure, order flow, and institutional behavior. And when a zone fails, it also fails for a reason. 3 major factors determine whether a zone will hold or collapse. And once you understand these factors, you stop blaming the market and start reading it with clarity. The first factor is market structure. A zone that aligns with the trend has a much higher probability of holding. When the overall structure is bullish, demand zones naturally become stronger because buyers are already in control. You're trading with the flow, not against it. But when you try to sell from a supply zone inside a strong uptrend, you're standing in front of a moving train. The market may pause for a moment. It may even react slightly, but the overall structure will continue to push upward. Trend gives direction, and direction gives strength. The second factor is the depth of the pullback. A shallow retracement, where price barely pulls back before trying to continue, usually signals weak participation. It means institutions did not place enough orders during the return. But a deep retracement, where price revisits the heart of the zone, often reflects genuine institutional interest. The deeper the pullback, the more meaningful the reaction. Deep pullbacks often produce the strongest reversals, because they tap directly into the core of unfilled orders left behind. The third factor is how many times a zone has been tapped. The first tap is always the strongest because it's the closest to untouched institutional orders. With each retest, those unfilled orders get consumed. The zone becomes weaker, thinner, and easier to break. By the third or fourth tap, the zone is often exhausted. Retail traders may still believe in it, but institutions have already moved on. And the market eventually pushes through with force. When you combine these 3 factors, trend direction, depth of pullback, a number of taps, you begin to understand why certain zones hold beautifully while others crumble instantly. It's not random. It's order flow logic. Zones work when structure aligns, liquidity is present, and institutional orders remain untouched. They fail when structure disagrees, pullbacks are weak, or the zone has been overused. Mastering these dynamics turns you into a trader who anticipates the truth of the market instead of reacting blindly to it. In the end, supply and demand is not just another trading strategy. It is the foundation of how every market in the world moves. Whether you're looking at Forex, crypto, stocks, indices, commodities, or even lower liquidity markets, the same principle repeats itself again and again. Price rises when demand is greater than supply, and price falls when supply overpowers demand. This simple truth holds across every time frame, from the 1-minute chart to the monthly chart. And that universality is what makes this approach so powerful. But even though the concept is simple, mastery requires patience. That is where most traders fail. They want instant signals, instant entries, instant profits. The market doesn't reward impatience. It rewards precision. The trader who waits for the clean retest, who studies the structure, who marks only the strongest zones, always performs better than the one who jumps in at every minor fluctuation. The truth is, you don't need 20 trades a week. You need 2 or 3 high-quality setups that align perfectly with your rules. And that brings us to the core of consistent profitability. Choosing only A-plus setups, not average ones, not emotional ones. Only the setups where momentum is clear, where the zone is clean, where the structure supports the direction, and where the narrative of the chart makes sense. When your criteria becomes strict, your accuracy increases, your stress decreases, and you no longer feel the need to chase every candle. Supply and demand teaches you to think like an institution, not like a retailer. It teaches you to wait for price to return to a zone rather than forcing an entry. It teaches you to respect imbalance, to read movement, and to understand where large orders were placed. And the more you refine this skill, the more you realize that trading is not about predicting the future. It's about identifying where the probability lies, then acting with discipline. So remember this: the strategy works. It works on all markets. It works on all time frames. But it only works for the trader who has the patience to wait, the clarity to mark correctly, and the maturity to walk away from low-quality setups. When you combine patience, precision, and discipline, supply and demand stops being a strategy and becomes a complete trading mindset.